Everyone watches the Fed thinking they control mortgage rates. But what if I told you that's actually a total myth? The truth is, mortgage rates move because of investors in the bond market, not the Fed. And those investors, they react to things like inflation, recession fears, and their need to make a profit. If you really want to understand why rates go up and down and what to watch for, you have to follow the money. Because once you know what bond investors are actually looking at, you can predict where mortgage rates are headed next. Now, to be fair, the Fed does control one key rate, but it's not mortgage rates. When you hear the Fed is raising or lowering rates, they're actually moving something called the federal funds rate. That's the interest rate banks charge each other for overnight loans, and it directly affects things like credit card interest rates, auto loans, commercial loans, and home equity lines of credit. So yes, when the Fed hikes rates, borrowing gets more expensive for businesses and consumers, but mortgage rates don't necessarily work that way. Think of interest rates like a seesaw. The federal funds rate is on one side, short-term overnight lending. Mortgage rates are on the other side based on long-term bonds, particularly mortgage-backed securities. So mortgage rates move based on what the investors expect to happen over the next 10, 20, or even 30 years, not just what the Fed does today. All right, so the Fed isn't setting mortgage rates. Well, then who is? The answer? Investors. More specifically, mortgage rates are tied to bonds, especially something called mortgage-backed securities. Think of a bond like a loan that an investor gives out. When an investor buys a bond, they expect a fixed return, which is a set amount of interest paid on a schedule. And here's the kicker. That return never changes. No matter what happens in the economy, the bond pays the same dollar amount in interest year after year. But here's where it gets tricky. Imagine bonds are like a water bucket that gives you the same amount of water, let's say 1 gallon per month. When inflation stays low, that gallon stays valuable. It's enough to meet that investor's needs. But when inflation kicks in, it's like poking holes in that bucket. Suddenly the same gallon is worth less because it won't go as far as it did previously. So, what do these investors do to protect themselves? They demand more water up front next time. In other words, they want higher interest rates to make up for that lost value. If investors expect inflation to rise, suddenly bonds look less attractive because the fixed payments won't be worth as much in the future. The only way bonds become appealing again? Higher interest rates. So, when inflation fears grow, investors sell off bonds and move their money into stocks to get better returns and keep up with inflation. And that pushes mortgage rates higher. If inflation pushes mortgage rates higher, what brings them down? The answer to that is fear. When investors get nervous, whether it's talk of a recession, global uncertainty, or a stock market crash, they start looking for safety instead of chasing those high returns. Here's the best way to think about it. The stock market is like a high-speed sports car. It's fast, exciting, and built for growth. When the road's clear, which is a strong economy, low inflation, investors put the pedal down, chasing returns in those stocks. But what happens when the weather turns? When we see a recession warning, a major market sell-off, or a banking crisis, when that happens, driving a sports car in a veritable snowstorm is not a great idea. So investors switch vehicles. They park that high-end sports car, stocks, and move into something safer, bonds. Bonds are like a sturdy pickup truck, slower, steadier, and built for tough conditions. Not as thrilling, but certainly more reliable. And when more money moves into bonds, their yields drop, which means mortgage rates drop too. This is why bad economic news can be good for mortgage rates, because uncertainty makes investors run for safety. Now that we know that the Fed doesn't set mortgage rates directly, you might be wondering, why does everyone watch them so closely? Because the Fed's actions signal how aggressive they'll be in fighting inflation. If the Fed is raising rates and tightening policy, they're trying to slow the economy. If the Fed is cutting rates and loosening policy, they're trying to stimulate the economy, which is usually because they're worried about a possible recession. So, while the Fed does not directly control mortgage rates, Their decisions shape what investors expect, and that's what actually moves rates. Okay, here's the deal. Mortgage rates don't move because the Fed says so. They move because investors are constantly reacting to what they think happens next in the economy. And if you know what to watch for, inflation, the bond market, the stock market shift, Fed policy, and job numbers, you'll have a much better idea of where mortgage rates are going to head next. All right, y'all got this.